Afternoon, ladies and gentlemen. It gives me great pleasure to welcome you all to this webinar on a Friday afternoon. As you are aware that we have been doing these sessions on a regular basis for over the last 3 months. And we are very grateful and thankful for the response that you have been giving to each of these sessions. Normally we do these sessions on a Saturday. So this is the first time that we are attempting to do something on a Friday afternoon. And I thank each one of you for taking time off to come on a Friday afternoon to be in this webinar. Most of our webinars in the past, as you are aware, were more focused towards what's happening with respect to the Indian markets and the sentiments thereof in terms of investments and opportunities. Today we are doing something different. In the sense, we want to give a flavor of the global markets, the global perspective on how markets have fared over time. This is basically a session where we will go back in history and see how pandemic is one of a sort of a situation. We have had multiple situations in the past, like the dot-com bubble, or it could be the energy crisis way back in the 70s. So each of these crises throw up interesting ideas and thoughts and investor behaviors and patterns. And this is precisely what we would be looking at today in this webinar today. And to lead this webinar and to take this session forward, we have Mr. Leo Naes from the Franklin Templeton. Mr. Naes is the lead of Franklin Templeton Academy for the EMEA region. He joined Franklin Templeton Investments as a senior learning consultant, providing training support to their strategic partners such as financial advisors and private bankers. He has been working with the asset management industry for more than 12 years. Mr. Leo holds a master's degree in international economics and business. He speaks Dutch, English, and Spanish. So let me now thank Mr. Leo for taking time off and to address our clients today. And I also wish to inform each one of you that that this is going to be a very generic sort of a presentation on global markets and the trends and the happenings. So if there are any questions, please let those questions be addressed on those sides. We may not be able to take stock specific or some certain specific questions because that is not the agenda of the webinar. So please, I'm sure this is going to be a very interesting and enjoyable webinar. And I would now hand over the session to Mr. Leo. Mr. Leo.
Thank you very much, Krishnan, for your introduction, and good afternoon, everyone. Welcome, and thank you for attending this webinar from Franklin Templeton on Unchartered Waters. And like Krishnan said, my name is Leo Niers. I'm the EMEA lead for the Franklin Templeton Academy, and I'll tell a little bit more about that shortly. Very quickly, this is going to be an interactive webinar, so the success won't only depend on me, but it will also depend on your participation. I will be asking a number of questions via the chat, so please participate via the group chat today. I'll put my video off for now so you can have a focus on the screen and the content. But first of all, I would like to tell you a little bit more about the Franklin Templeton Academy. So as you can all read, the Franklin Templeton Academy is an independent vertical within our global organization, really with the aim of providing added value service to our clients. And the program seeks to support our financial professionals and clients in their day-to-day job. And we do this by offering pragmatic and interactive training on the financial markets and investment concepts, independent of the Franklin Templeton product offering. So we offer around 25 different courses to our clients. And if you are interested in more courses, please visit our website, franklintempletonacademy.com, and we offer those courses in 3 different formats. So some of those courses are available in e-learning, in web-based training. This is self-paced training that you can do in your own time. So again, please have a look on our website if you're interested in following some e-learning courses. We used to do a number of classroom sessions in the Middle East as well. They have been reduced, obviously, due to the global lockdown, and that's why recently we conduct many more webinars like we do today. But we run all these training with a certain style. So first of all, I won't talk about any funds or any of our products today. If you have any questions on any of our funds, please follow up with my colleague Naveen Kumar, who's also on the call. It will be purely educational what we're covered today. The session should be pragmatic, so hopefully this presentation gives you some direct tools that help you to better navigate your investments in these volatile times. It should be informative, but like I said before, it should also be interactive. So please participate through the chat today. And hopefully this session is also fun for you to attend. Right. Let's move on and start with our main topic today. So let's talk about uncharted waters. So the financial markets are going through turbulent times at the moment. And the aim of this presentation is to place the current market volatility and shocks into a historical perspective, to describe how various emotional biases affect our decision-making ability, and to provide 3 proven strategies to better cope with market volatility. But first of all, I've got a question for you, and perhaps you can answer that question in the chat today. So how would you describe the path of the financial markets over the last couple of months? So how would you describe the path of the financial markets over the last, what words would you use for that? And I see Shrikant is saying like a yo-yo. Indeed, I like that expression. In other wordings, some people are saying volatile, turbulent, I think. Adventurous is another word to describe the state of the markets. Some people see it as an opportunity as well. Some people say emotional. That's something what we will be addressing today in this presentation as well. So uncertain, emotional, volatile, unpredictable, uncertainty. These are all great words to, I think, describe the state of the financial markets over the last couple of months. And we will be addressing those various words in this presentation. So thank you for participating there. Right, let's move on. So what you see here is, with all the recent news around the coronavirus pandemic and the related market volatility, investors may be wondering, how are these events impacting my investments? And this chart shows the growth of the MSCI All Country World Index, which is a global index consisting of stocks from developed and developing markets over roughly the past 10 years until the 31st of May 2020. And an index is a method to track the performance of a group of assets in a standardized way. Indices typically measure the performance of a basket of securities intended to replicate a certain area of the market, such as, for example, the Nifty 50 or the BSE Sensex track stocks for the Indian market. Now, the annualized return over this roughly 10-year period for the MSCI All Country World was 9.1% on a yearly basis, as you can see in this chart. So as you can see, up until recently, we've been fortunate to experience a bull market over the last 10 years. And those of you who've just started investing recently or over the last couple of years have never experienced a significant downturn. So let's zoom in to a bit more recently, and let's discuss some news event around the coronavirus pandemic. Right, so what you see here, if we zoom in until the events that has happened year to date in 2020, then we can see that the coronavirus started or was first reported from Wuhan, China, on the 31st of December 2019. On that day, the government in Wuhan confirmed that health authorities were treating dozens of cases. And on the 11th of January 2020, Chinese state media reported the first known death from an illness caused by the corona pandemic. Then a couple of days later, towards the end of January 2020 of this year, it was the World Health Organization who declared COVID-19 as an international public health emergency, as cases were reported outside China. 3 days later, the first coronavirus death was reported outside China. Then on the 18th of March, it was the European Central Bank who announced a 750 billion euro pandemic emergency purchase program. And a few days later, the Federal Reserve came with measures to support the economy as well. On the 2nd of April, the World Health Organization confirmed that the world was hit by 1 million confirmed cases. And it was only towards the end of April when both the World Health Organization and various countries in Europe published guidelines aimed at reopening some parts of the economy. On the 13th of May, it was the United Nations who forecasted that the pandemic would shrink the world economy by 3.2% this year. And by the end of May, the lockdown restrictions were eased in many European countries. However, protests against police brutality in the US sparked fears of new virus outbreaks. So the coronavirus outbreak is unprecedented, and it may be too early to tell how this will impact the economy. However, we do know that volatility can cause investors to act on their emotions, and that lessons learned from the past can help in navigating these uncharted waters. Right, so let's move to the learning objectives of this webinar today. So by the end of this webinar, you'll be able to place current shocks in a historical perspective. You'll be able to recognize how emotions affect our decision-making ability, and we'll identify 3 strategies to better cope with market volatility. But let's first put the current shocks into a historical perspective. And while most investors know that markets go through cycles, it's in times like these, when markets are stormy, that emotions are running high. A historical view focusing on relevant research, solid data, and proven strategies can help put current events into perspective. So let's first have a look at the past. So I've got a new question for you, which you can hopefully answer via the chat. So how many times have global equity markets experienced a bear market between 1969 and the end of 2019? So I'll post that question in the chat. So how many times do you think global equity markets experienced a bear market? So that's a decline of 15% or more over a 50-year period from 1969 to 2019. And see some of you say 7, some of you say 10, 15. Yeah, so I think I see all the answers coming in, and the answers vary quite a bit. It varies indeed between 7 and 15 times. And the right answer, as you can all see right now in your screen, was actually 10 times. So over this 50-year period, the global equity markets experienced a bear market 10 times. And that's what we actually see nicely in the next chart. So in the next chart, here we have expressed global equity markets into bull and bear periods, right? And a bear period is defined as a drawdown of 15% or more. And this is actually still quite conservative, as in most economic analysis, a bear market is defined as a drawdown of at least 20%. And as you can see in the chart, over that 50-year period, the global equity markets experienced a bear market 10 times. So 10 times there was a drawdown of 15% or more. So that was the right answer, 10 times. But a bull market starts when the previous bear market has reached its maximum drawdown and continues until another 15% decline or more. Now there's two important conclusions that you can draw from this chart. First of all, you see that on average, bear markets have decreased less than the increase in bull markets. So in other words, the amplitude of decline in bear markets was much smaller than the amplitude of increase during bull markets. That's one conclusion. The other conclusion is that you can see that on average, bull markets have tended to last much longer than bear markets. So the average time of bull market was much longer than the average time of bear markets. And that's something we have summarized in the next chart as well. So here you see that on average, over that 50-year period, bull markets lasted on average 3 years and 5 months, and the average growth was 146% during bull markets. Whereas bear markets, on the other hand, tended to last 1 year and 1 month, so much shorter. And the average fall during bear markets was only minus 30%. And that brings us back to one of the investment fundamentals of one of our founding fathers, Sir John Templeton, who already mentioned decades ago that it's time in the market, not timing of the market, that helps to generate robust investment results. So hopefully these charts have helped you to convince the importance of staying invested for the long term. We'll be coming back to that important concept later on in this presentation. But let's have a closer look at viral outbreaks. Viral outbreaks are not new to the financial markets. And while markets react to news events in the short term, they've tended to reward patient investors over a longer period of time. So let's have a look at some examples of viral outbreaks. So in 2003, SARS saw 8,000 people infected. It was brought to an end by good hygiene and environmental factors due to warming temperatures. It burned out when enough people became infected to build an immunity to the disease. Then a couple of years later, in 2009, we had the swine flu. In 2014, the Ebola virus broke out in West Africa and ended with human intervention when the World Health Organization declared an international response. Countries worked together to manage the sick, and when a second outbreak occurred in 2018, treatments developed from the first outbreak were offered to patients. Then in 2015, you might remember we had the Zika virus outbreak, predominantly in South America and in certain Asian countries as well. And that brings us to today. There's nothing exactly like the coronavirus. We don't know yet how everything is going to play out, but you can compare it to historical epidemics to help put things in perspective. Some investment managers are comparing the coronavirus crisis to 9/11 or natural disasters such as tsunamis and earthquakes. History remained the same. In all events, over the long term, the financial markets have recovered. And that's something we also nicely see in the next slide. So on the next slide, what you'll see is that historically, markets have tended to rebound quickly from viral epidemics. So this chart shows how the performance of the prior epidemic from the start of the global interest to the peak in global interest. And global interest is measured by story counts on Bloomberg. So in this column, you see how various markets, local markets, reacted to the viral outbreak from the start of interest to the peak of interest. And again, the interest is measured by the number of stories published on the virus on Bloomberg. Now, what you see is that 1 month after the peak in global interest of these viral outbreaks, the market showed signs of recovery already. 1 month after the peak of global interest, the markets on average saw a gain of 12.3%. And even 3 months after the peak in global interest, we see that the markets on average saw a gain of 23%. And again, we don't know yet how COVID-19 is completely going to play out. We see that the markets have recovered a bit, right? We don't know yet how it is going to play out exactly, but we do see how markets have tended to rebound quickly from other viral outbreaks in the past. So let's have a look at what's going on in our heads when we're have to deal with volatility of the market, because some of us might feel we're riding a roller coaster. So let's have a look what's going on in our heads and why. So when we make decisions, our frontal cortex processes a lot of information to make logical and informed decisions. Usually we can do this quite well, such as, for example, what to eat, what clothes to wear, etc. But then there's the little part of your brain known as the amygdala. It's often referred to as the reflexive part of your brain because it connects to stimuli in the world around you, to experiences. So while our frontal cortex gives us the logical response, our reflexive brain acts on emotions. Now, let's give an example of that. You might remember the caveman, right? And the amygdala may help us when we were confronted by a tiger in the past. Based on past experiences, the amygdala would tell the caveman that now might be a good time to run. In fact, the amygdala is often associated with fight or flight responses. But letting the amygdala or our reflexive brain control our reactions when making financial decisions may lead to some undesirable outcomes. So based on that, we will now discuss several behavioral biases or forms of irrationality that we are often likely to display in times of volatility. And the first bias we'll discuss is anchoring. And anchoring means that we often focus too heavily on one piece of information when making investment decisions. And we all know that if we buy a stock, and that stock increases in value and at some point reaches an all-time high, but then decreases a little bit in value, then to many of us that feels as a loss because we are anchored to that all-time high, even if the current stock price is higher than the original purchase price of the stock, because we remain anchored to that all-time high. So even when we're presented with new information, we remain anchored to the old piece of information. Now let's come up with an example of anchoring. So anchors have a powerful hand in our decision making and can create unrealistic expectations for investors. We asked investors in a survey to tell us their average annual portfolio return expectations over a 5-year period, and the median response was 10%. However, when we presented those investors with a hypothetical market that was up 20% that year, investors would adjust their portfolio expectations after introducing that anchor of 20%. And they would abandon their original return expectations. Later, when we introduced a hypothetical return of that the market was down by minus 20%, the median return expectation was positive 3%. So surprisingly, investors expected to outperform a down market by 23%. Now let's come up with another example of anchoring, right? So let's see how it influences our investments. Imagine investing $10,000 10 years ago and setting a goal to earn 7% consistently annually on your investment portfolio. So here you see the result. If you would have gained an annual return of 7%, that $10,000 10 years ago would be worth roughly $20,000 with return of 7%. But now, let's say you would invest in the stock market, right? 10 years ago. In this case, the MSCI All Country World, the global stock market, then you would have gained an annual return of roughly 9.4%, and your account balance would have equaled roughly $25,000 after 10 years. The reality of the market, however, is that it doesn't move in a smooth fashion, right? After a number of years, when the market hits a new high point, it's easy to anchor to this new higher return expectation and expect higher returns afterwards. But if the market drops, you may feel like you have lost, losing sight that you're actually still on track to reach your long-term goal. So it's important to keep focused on your long-term strategy and not let anchoring that may come with short-term volatility steer you astray. So hopefully that all makes sense, how anchoring is affecting our return expectations. Let's move on to the next bias then. And the next bias is loss aversion. So loss aversion means that the pain we associated with a loss is much more intense than the reward we feel from a gain. And investors exhibiting loss aversion, they tend to sell the winning stocks in their portfolio in order to lock in the gain, because that feels good, and to hold on to the loss-making stocks in their portfolio in the hope that at some point we get back to even. This is known as the disposition effect. The result of this, if you constantly sell your winning stocks in order to lock in that gain and hold on to your loss-making stocks, then we all end up with a portfolio full of loss-making stocks. And in fact, and we'll have a quick exercise around this loss aversion. And this exercise was first conducted by a famous psychologist who won the Nobel Prize in economics, Daniel Kahneman. You might have heard of him. He wrote a good book, Thinking Fast and Slow. I would definitely recommend that book if you're interested in this. But Daniel Kahneman did the following experiment. And so he asked, a friend wants to make a bet with you, and you'll have a 50% chance of losing $10,000 and a 50% chance of winning an unspecified amount. How much would you want to be able to win before you would accept the possibility of losing $10,000? So I repeat the experiment of Daniel Kahneman. So a friend wants to make a bet with you. You have a 50% chance of losing $10,000 and a 50% chance of winning an unspecified amount. How much would you want to be able to win before you would accept the possibility of losing $10,000? Can you please answer that via the chat? Right, so how much would you want to be able to win before you would accept the possibility of losing $10,000? I see some answers coming in. 20,000. I see 200,000. So that is indeed 20,000, 25,000. Some of you are saying. See some answers. 30K, 50K, 150K, at least 20K. So I see all kinds of different answers coming in. And the truth here is that there is not really a right or wrong here. Perhaps the only irrational answer here is if you would accept less than 10,000. Because if you would accept less than 10,000, then if you would repeat this experiment a number of times, you would always make a loss. The question is, how much more than 10,000 would you accept? And that differs for all of us. That depends on your risk tolerance. And we're all different as human beings. We all have different risk tolerances. However, on average, Daniel Kahneman found out among his students that people would want to accept at least 20,000 on average before they would go ahead with this bet. So he concluded that often people, they give twice as much about their losses than they give about their gains. In other words, the pain of a loss feels twice as hard as the pleasure from again. And that's what he wanted to indicate with this experiment. So again, loss aversion has some other consequences. For example, that we sell out of our risky portfolio, risky assets, and that we move into safe haven assets. And this is something we saw, for example, after the dot-com bubble, which reached its peak in March 2000, after the technology bubble. Investors moved around 490 billion US dollars into cash just after the dot-com bubble collapsed over that period between March 2000 and October 2002. Right? Similarly, after the global financial crisis, investors piled about $943 billion into cash in the period from October 2007 through March 2000. These were times of volatility in the stock markets, and we all have the tendency to move our money into cash. The drawback of this is what you see in the next chart, right? So unfortunately, for a long period, is that moving your money into safe haven assets, like moving it into a bank account, might actually come at a cost. We all know that interest rates, money market yields are very low at the moment. In the US, it's about 0.15%. In Europe, they're even negative in some countries. And specifically, if we adjust for the effects of inflation, right? We see that investors are earning a negative real yield by moving their money into cash. So this is not a solution either. It might feel like a safe haven asset, but many investors don't take the effects of inflation into account and are actually don't realize that they're earning a negative real yield if they move their money into safe haven assets, such as, for example, a bank account. Right, so that's the consequence of loss aversion, that many investors move their money into cash. Right, let's come up with 3 strategies how you can better deal with market volatility. Right, and the first one we mentioned already, but the first one is to focus on the long term. First, and arguably the most important concept, is to stay calm and keep a long-term perspective. Something that you really have seen over the last in the last couple of months is the next chart. So what we've done here is, over a period of 10 years, we put the 20 worst trading days and the 20 best trading days next to each other. Right, now what you see is that often in times of volatility, the worst trading days are immediately followed by the best trading days. And the other way around, that sometimes the best trading days are followed by the worst trading days. And this shows how difficult it is to time the market, to be invested just before a best trading day and to be withdrawn from the market just before a worst trading day. None of us has a crystal ball. None of us knows exactly what's going to happen tomorrow. In other words, nobody can time the market. Right? And timing the market might be costly as well. That's what we see in the next chart. So what we see here is we look at the annualized return of the MSCI All Country World over a 10-year period. Now, if you, over that 10-year period, would have missed the best 10 trading days, your annualized return would be 4.3%. Would you have missed the best 20 days, your annualized return would only be 1.6%. Would you have missed the best 30 days, your annualized return would be even negative over that 10-year period, minus 0.8%. And would you have missed none of the best trading days? In other words, if you would have stayed fully invested, you see that your annualized return would be 8.8%. In other words, this shows how important those best trading days are for the overall return and how costly it can be to miss those best 10 trading days. And in the previous slide, we showed how difficult it is to time the market. It's nearly impossible. So you're better stay invested rather than to try to time the market. Right, another concept here is a question for you. How often do you look at your portfolio? Can you answer that via the chat? So how often do you look at your portfolio? You can just be honest about it. Some of you say monthly, other ones of you says daily, weekly, every 3 days. Some of you even says once a year. Weekly, so again, that varies very much among all of us, right? Twice a week, right? Somebody even says every hour. Wow, that's that's very often to watch your portfolio every hour. But this is one of the main drawbacks, I think, of today's environment, where we all have access to our portfolio via apps or via the internet, right? And stock markets rise and fall every day with many ups and downs throughout the day. This may cause anxiety for those who keep their eyes fixed on the daily market movements. The more they watch their portfolio, the more they lose. So let's exemplify that here with an example. So suppose you were investing over a 5-year investment horizon. Your perception of your portfolio would change depending on the monitoring period. If you would be monitoring on a monthly basis, you would observe a loss 37% of the time. However, if you only would be monitoring on a 5-year time frame, it would have been positive 90% of the time. In other words, investing is something you do for the long term, and we might get distracted by the daily noise of the market, specifically when markets are volatile. But don't forget that investing is something you do for the long term. And if you watch your portfolio on a very frequent basis, it might cause anxiety with you. And hopefully this example has illustrated that. So keep a long-term perspective. That's what we illustrate again in this one. So here we look over a 30-year period, right? And you do see that the market has experienced some crisis. For example, the tech bubble that bursted in March 2000, the subprime crisis, which resulted in the global financial crisis in 2008. We had the European debt crisis in 2010, and now we have COVID-19. Despite all those crises, the markets still gained a cumulative return of almost 690% over those 30 years. And that comes down to an annualized return of 7.1%, right? So despite those crises, you see that markets tend to move upward, but not in a regular fashion. That's something we've illustrated here as well. So here we look at European equities, and over the last 50 years, and we look at various performance periods. We look at 1-year periods, 2-year periods, 5, 10 until 20-year periods, and we roll those periods on a monthly basis through time. So if we look at all 1-year periods on a monthly basis over a 50-year period from 1969 to 2019, we had 590 different 1-year periods. One was the best during the technology bubble between 1996 and 1997, you would have gained 71%, and one was the worst between February 2008 and February 2009, you would have lost minus 40%. So you see actually that the dispersion between the best and the worst 1-year periods is rather big. It's about 115%. But looking at longer periods, let's say 4-year periods, we see again that we had fewer observations simply because 4-year periods last longer than 1-year periods. We had a best 4-year period between April 82 and April 86. You would have gained 37.5%, and a worst period between March 1999 and March 2003, you would have lost minus 10%. Now, what we do see is that if we look at the dispersion for 4-year periods between the best and the worst periods, that's actually much smaller. In other words, 48% compared to the dispersion for 1-year periods, which was around 115%. So let's look at even longer periods. Let's look at 13-year periods. Again, we had a best and a worst 13-year period. And here we see something surprising, that if you would have invested in European equities for 13 years or longer, you would have always gained a positive return, because you see here that the worst period is still plus 0.3%. Right? So independent of when you started investing between 1969 and 2019, if you would have held on to your equities, European equities in this case, for 13 years or longer, you would have always made a positive return, irrelevant of when you started investing. And this is purely looking at index return. You could have enhanced your returns by, for example, diversifying over several asset classes or hiring an active manager. And again, here you see that this trend is actually continuing. So for 13 years period or longer, there are no negative return periods anymore. And if we even look at 20-year periods, then we see that that trend, or that return dispersion between the best and the worst return, that is actually decreasing over time. So the longer the holding period, the smaller the return dispersion. So another way of expressing how important it is to hold on to your equities for the long term. And finally, we have expressed that in one other chart. You see that here. So over the last 20 years, we look at calendar year returns for European equities. Now what we see that every year there was a certain drawdown, right? The blue bars in this chart. Every year there was a drawdown. However, despite those drawdowns that happened every year, out of the 21 years to be more precise in this chart, we see that 15 calendar years ended positively, indicated by the green bars, right? So despite drawdowns that happened every year in European equities, the markets ended positively 15 out of those 21 years, as you can see in this. So again, that shows the power of perseverance and the importance of staying invested for the long term. Right, hope that's clear to you. Let's move to the next piece of investment advice, and that might be a cliche, but it's very important, which is diversification matters. So diversification may reduce your overall volatility and provide a smoother ride through bumpy markets. And perhaps there's no better chart that illustrates that than the next chart. So here we basically show 10 different asset classes and their calendar year returns each year. So we put the best performing asset classes each calendar year on top and the worst performing asset classes on the top. Now let's look at, for example, one asset class, which is, for example, equities from emerging markets, the blue cells in this matrix. You see that they had a very good performance from 2005 to 2007, but they were the worst performer during the global financial crisis in 2008. And again, the best performer in 2009. So clearly you would have felt good at the end of 2007, but you would have felt so good at the end of 2008. Now there's no clear pattern that repeats itself, right? Nobody knows how this ranking will look at the end of 2020, right? So therefore your best bet, according to us, is to diversify, to spread your wealth over several asset classes. And we have summarized that important message around diversification by means of some other research as well. So here we have 3 strategies. So the first strategy is called chasing the winner. So basically we started investing $10,000 each year since 2000. And we allocated that $10,000 depending on the strategy. So chasing the winners meant that each year we would invest our entire capital into the asset class that performed best in the previous year, thinking that this asset class would continue to outperform. Our second strategy would be to invest with the losers. In other words, we would allocate that $10,000 each year to the asset class that would perform the worst in the previous year, thinking that this asset class would bounce back. This is a bit known as a contrarian strategy. And our third strategy would be the diversification strategy, which means that we would equally spread our capital over the asset classes available in our exercise. And you can see, perhaps guess what would be the best performing strategy. So over those 20 years, you actually see that the diversification strategy not only produced the highest return, it also came with the least volatility. So diversification is a timeless investment tip that you should always consider. So spreading your investments over several asset classes. Right, and our final tip would be to stick to your goals, right? When markets are volatile and emotions are running high, it's important to stick to your long-term goals. Some investors, they just invest for the sake of investing. They don't align their investment in line with their goals. They're much more likely to pull out of the market in times of volatility. But if you see your investments in line with your long-term goals, you're much more likely to stay invested and to achieve those goals over the long term. And you're less likely to be distracted by market swings. Now, one important thing to do in times of volatility is rebalancing. So rebalancing basically means that the asset allocation ranges of your portfolio will evolve over time. And portfolio rebalancing involves adjusting your portfolio's asset allocation ranges to best suit your original objectives and risk tolerance. So let's illustrate that with a concept. So for example, let's say in 2002, you started with a beginning allocation of a portfolio consisting of 50% equities and 50% bonds. This was your strategic asset allocation. In the subsequent years, a bull market happened, which usually means that equities outperform bonds, and therefore your allocation ranges would have changed. You would have a greater exposure to equities at the end of October 2007 compared to bonds, because equities would have increased more than bonds. So that might be a time that you would need to rebalance your portfolio again back to 50-50, to your original strategic allocation. Now, the same happened, for example, when a bear market is happening, right? So let's say you started with a 50-50 allocation on the 31st of October 2007, and a bear market happened, had a global financial crisis in this case, which in a bear market, usually bonds outperform equities. So you would have had a greater exposure to bonds, right? And again, now is the time to rebalance again. After a bear market, after equity markets have sold off, equity valuations might be cheaper, and now is a good time to basically bring your asset allocation back in your original, to your strategic asset allocation, which is in line with your long-term goals. So now is the time to perhaps make an appointment with your financial advisor and rebalance your portfolio. The last investment tip we have is to basically systematically invest in the market. This is also known as dollar cost averaging, or in other words, you better invest in small amounts regularly than that you invest a big amount all at once. Because if you invest a big amount all at once, you're basically timing the market. And as we've seen earlier in this presentation, nobody can time the market. So systematic investing is investing a fixed amount of money at regular intervals to an investment. And basically you're buying more shares when the market decreases, and you buy fewer shares when the market increases, resulting that your average cost per share may be less than the average price per share. So that's another important investment tip. Please continue to invest regularly at regular intervals rather than invest a lump sum at once. Right, and that brings us to the end of this presentation. So let's summarize what we discussed today. So first of all, history has shown us that while markets react to shocks in the short term, they've tended to reward patient investors over the long term. Secondly, our emotions affect our decision-making ability in times of market volatility. And finally, we identified 3 ways to better cope with market volatility, which were to, first of all, keep on focused on the long term, to have a solid diversification, and finally, to remember your long-term goals. Right, and that brings us to the end of this presentation. And now there's an opportunity for any questions. So let me go on video again. So I open it up for any questions right now. So I got a question here. So yes, when is profit taking suggested? That's always yeah, it depends on your goals. Yeah? Basically, we all have the tendency to basically sell our winning stocks, as I explained, by means of the loss aversion, and because that feels good, to sell our investments and to lock in the gains. But the question is, what are you going to do with that cash once it comes in? Do you really need it? Or is it more efficiently allocated when it's in the market? Because we've also seen that putting money just in your bank account doesn't yield anything, or even worse, it has a negative yield if we take the effects of inflation into account. So it all depends on your goals. Now, how many stocks are recommended in a portfolio? We basically deal with mutual funds, but generally I would say there's at least 30 stocks in a mutual fund, and this has a technical explanation because in that way usually all the idiosyncratic risk or the risk that is unique to each stock is diversified away, and you are at least left over with the market risk, the beta risk, which cannot be diversified away. So yeah, I would say at least between 30 and 60 stocks. What are some other questions on the yeah, when the markets are like now, whether we need to shift stocks from small cap, mid to blue chips. So usually large cap or blue chips tend to be a bit more solid during times of volatility compared to small and mid cap stocks. So yes, to answer one of the questions on your phone. There's a question on the technology fund, which my colleague Naveen can follow up with you. Is it advisable to invest in gold at this time? Now, one of the problems during market volatility and over the last is that in times of volatility, investors don't only sell equities, they sell bonds, they basically sell all kind of risky investments, which means that the correlation, which basically tells whether stocks move in line with each other or whether they move opposite to each other, those correlations are going up. Now, in times of volatility, these correlations are going up. So that means sometimes that you're less diversified, unfortunately, and gold is one of the few, I would say, indeed diversifiers in these times of volatility. So it might be advisable to add some gold to your portfolio right now. How serious do we take the rating agencies? That's yeah, the rating agencies like S&P and Moody's. They had obviously a very yeah, a bad reputation during the global financial crisis in 2008. in those days there was really something wrong with the fundamentals of some of those structured products like mortgage-backed securities, right? They still received a good credit rating, while the underlying bonds were often of less greater quality. Right now, there's not so much wrong in terms of the fundamentals of the economy, right? But so in that sense, I think there's probably a better picture from the credit ratings than compared to the 2008 crisis. Yeah, your thoughts on ETFs. There's various sorts of ETFs, of course. ETFs have proven their role in terms of liquidity, right? That's always a huge concern around ETF. I think they have stand the test through time, through this market volatility, and they did what was promised on the tin. Perhaps one type of ETFs, the so-called smart beta ETFs, have done a bit less, because obviously they tend to equally weight stocks, and most indices are market cap weighted, and that's something that companies like Amazon, like Apple, they have had a much bigger weighting in the index. And therefore, perhaps these smart beta ETFs have performed a little less at the moment. I don't really do any questions on outlook or sectors in the next 5 years. But yeah, how frequently should we rebalance your portfolio? I would ideally say on a frequent basis. So at least once in the 6 months at least. So check up with your financial advisor and make a checkup with him to rebalance your portfolio. Do you? Yeah, perhaps that's one of the winners. Do you think technology stocks will do better in the long term? At the moment, they are outperforming, and I think there's still some way to go for technology stocks. Clearly, the fact that we all do our meetings via platforms like Zoom today, that obviously have massively increased the success of technology companies. So I do think there's some room for further improvement to them. What should be our action in case of continuous slides for a year or so? Don't really know what's really meant with that question. What should our benchmark be to take a call on whether we should hold our positions or book our losses and looking for yeah, there is not so much a benchmark. In the end, I would say don't, like I said earlier, don't sell your stocks too early. Only if they're if it's in line with your goals, right? Don't just sell your winning stocks to lock in those gains if you don't have a specific goal with the capital that comes free after selling it. Continuously sliding shares like General Electric, which now at some point I don't do any advice on individual stocks like General Electric. That's perhaps something you should discuss with your financial advisor. Generally, I would say that General Electric is probably one of the stocks that is the oldest stock ever in a benchmark. I think the oldest stock in the Dow Jones Industrial Average. And I think specifically in times of volatility, it's always good to have some exposure to these blue chips or large cap stocks. I think we're almost coming to the end right now, Krishnan. So I don't know how many questions are coming in yet. but
I think that's
we're just at the
I mean,
hour right now.
just to wrap up the session, just a question from one of the clients who had sent it by email earlier.
Yeah.
They were asking, now we are this era of negative rates. Now we are seeing negative rates in debt markets. We have seen the sharp fall, for instance, the crude negative rate that we saw in the month of April. Do you think that these are all one-off events, or we may have to live with this sort of volatility of these sort of portfolio returns in the near term or the long term as well?
Yeah. Now are you referring to the negative interest rate?
Yes, negative interest rates. Yes.
Yeah, I mean, generally, that's, the response of the central banks is obviously unprecedented, not only in the US and also in Europe. I think in Europe, the ECB has now been on a policy of negative interest rates for the last couple of years. And the question is whether it is really worked. We have a good paper on that, which we can share with you. The question is, has it really encouraged banks to basically put more money into the economy? And I don't think the effects have yet really played out. The only thing we can obviously say is that the stimulus of the central bank has been unprecedented, even compared to the global financial crisis in 2008. And the effects of negative interest rates, some economists say it doesn't work, others say it does work. We can't really say yet if that has really a positive effect on the overall economy, or whether it has created bubbles in other sectors.
So I think it's time to wrap up this webinar session, and I would now request Mr. Shamsuddin, director of our company, to formally propose a vote of thanks to Mr. Leo and to Franklin Templeton.
Ladies and gentlemen, and Mr. Leo Neves, good evening all of you. When we listen about 1 hour, Mr. Leo Neves' presentation, we had a satisfaction as we attended a wonderful class of an economic professor. Normally, whenever you have these kind of webinars, our presenter always give technicals and other sides of the market. But today, we have opportunity to take one deep knowledge about the situation of the market and all. As a professor explaining to students, you made a wonderful presentation to us. It is a great satisfaction, all of us. I express our sincere thanks to all the attendees, as well as Mr. Leo Neves for giving a wonderful presentation. And I thank you all once again.
And thank you once again, Mr. Leo and Naveen, for organizing this session. It was extremely productive, and we look forward to engage with you for many more sessions in the near future as well. Thank you. Thank you very much.
Thank you. Have a good weekend. Take care.
Thank you.
In the last 25 years, the returns on various financial asset classes like bank deposit, gold, and real estate have multiplied several times. But there are a few select investments in the Indian capital markets that have had the potential to appreciate exponentially over 100 times. If you had known this at the right time, you would have taken the right investment decision, which is precisely why you need an expert's validated advice when it comes to investing. Welcome to Barjeel, one of the few SCA-approved financial intermediaries in UAE. We are wealth builders, guiding customers since 2001. We have serviced over thousands of them till date, and today we cater to large segments across investor groups. This speaks about our enormous goodwill and their undiluted trust. And we have earned that trust by telling, not selling. We educate you on the investment opportunities that are ideal for you. We then help you make an informed decision, impartial and unbiased, keeping your long-term goals in mind. And with us, everything is long-term, be it commitment, relationships, or success. We offer comprehensive insights across a wide range of products through a holistic approach. We ask you the most important questions, the answers to which will help you focus on your investment objectives. For example, you work for over 30 years. Are you saving enough for the next 30 years? For life goals like children's education, your daughter's wedding, or your retirement. Think about it. You work hard to earn your money. Does your money work hard enough for you? Barjeel, let's build your future. Come, let's talk.